How restructuring your business can help it recover. Business restructuring can encompass a wide range of activities, but it often entails redirecting the financial and operational strategy to improve profitability and efficiency. For example, when a firm has difficulty paying debt payments, it will frequently consolidate and change the loan terms in a debt restructuring, which boosts its ability to repay smaller quantities. Similarly, an operational reorganization typically entails a reduction in expenditures such as wages or asset sales. When a company's current situation may lead to its destruction, this is generally regarded as critical. But first, if you are new here, consider subscribing to this channel to continue receiving great weekly videos on consulting. Don't forget to hit that notification bell so you can get informed every time I publish a new video. A restructure in the business world can refer to financial and operational actions intended to protect the company, manage or revert financial difficulties, and maintain long-term resilience. A well-planned organization may help firms respond more efficiently to future risks and threats and provide the groundwork for a more robust and speedier recovery. Working of restructuring. When a corporation restructures internally, the operations, methods, departments, or ownership of the firm may change, allowing the organization to become more integrated and lucrative. Financial and legal experts are frequently employed to negotiate restructuring plans, resulting in changes to methods, computer systems, networks, locations, and legal difficulties. Positions may be terminated, and people may be laid off as a result of job overlapping. Process of business restructuring. Essentially, corporate restructuring is just what you'd anticipate. It usually entails altering your company's internal structure to better match your goals and demands. It includes, but is not limited to, debt restructuring to free up more capital and lower your overheads, corporate restructuring to alter the way your company is run, financial reorganizing to increase your company's profitability. Reasons to restructure your company. Restructuring your business entails improving its operational, financial, legal, or other structures to maximize profits and assure maximum efficiency. Restructuring is classified into two types: financial restructuring, which occurs when a company's debts and tax concerns are problematic, and organizational restructuring, which occurs when a company's organizational structure has become inefficient. The practical business reorganization will necessitate the collaboration of business professionals, your management team, and any key shareholders. If you opt to restructure your firm, it is because it is experiencing financial difficulties or is going through a formal insolvency resolution process, such as administration. On the other hand, you want to change your company. You may decide that a restructure is the best option. It can be due to financial reasons or micro and macroeconomic concerns affecting how a company operates. Appropriate time for the organization restructuring. The first thing you should think about is which type of corporate restructuring is best for your company. It usually comes down with the following reasons listed below. Financial distress. Your company is in financial trouble because it is losing money. Excessive prices and debts have grown to an unacceptable level, implying that you are having problems or are unable to pay. In addition, new legislation may have been introduced, necessitating examining your procedures or creditors. Management changes. Any development or growth may have made the management structure more complicated than necessary. Benefits of reorganizing. Restructure does more than reflect your company's current position. It also allows itself for what you might look like in the future. This reorganization process is usually beneficial, so you should not feel obligated to avoid it. There is, however, no hard rule. You are stating that your firm must continue to function in the same manner in which it was created. Types of restructuring. There are several sorts of restructuring, all of which are dependent on why you choose to reorganize your organization in the first place. Cost cutting. You have an increasing quantity of debt. Your company's operating costs are most certainly too high. As a result, reviewing your company's structure, whether in its administrative or operational areas, is highly advantageous. For example, selling unneeded assets to raise cash can reduce the number of employees or restructure specific divisions to remove superfluous management expenditures. Restructuring of debt. You may be able to reorganize your debt and continue to trade by proposing a company voluntary arrangement. The agreement implies that all of the company's debt can be transferred into a single, reasonable monthly payment, allowing it to continue business without fear of bankruptcy or winding up orders, applications, or liquidations. Thus, a voluntary corporate arrangement can be a practical approach to resolving major debt problems, and your firm could be legally debt-free in 5 years or less. Revenue has dropped dramatically. Poor financial indicators are a clear indication that your company has to be restructured. Declining sales can be an indication that your company is no longer profitable. Unexpected revenue declines might set in motion a cascade of events that leads to unpaid credit fees, taxes, and even employee benefits. Project work can assist you in identifying and resolving the underlying difficulties, allowing you to break even and eventually return to profitability. Inadequate competitiveness. One of the most precise signals that your firm requires restructuring is that your competition outperforms you. You're no more numbered 1 or 2 in your industry, and your competitors are undercutting you in areas ranging from customer service to product quality. Moreover, the imperfect competition offers a chance to reassess everything from your corporate strategy through your organizational culture, allowing your company to begin to ascend rather than sink behind your competitors. The rate of growth is slowing. If you'd like to grow your business but are having trouble doing so, it may be a sign that your company needs to be reformed. Your company may have a fair market share and decent profitability, however, you're unable to expand and scale up in the manner you desire. From your brand and service name to your personnel, restructuring can assist you in identifying economies and using the capabilities required to expand and become a powerful competitor. Debt dependency. The service of debts is a hardship for businesses that are significantly reliant on debt. As a result, development, working capital, and the ability to invest in critical success factors such as product development are hampered. A corporate restructuring allows you to create a new approach. Customer base shifts. If your consumer base is shrinking, you're buying less, or you're just looking for a different service or product, it's time to restructure your company. For example, you may need to lower production costs, launch an additional product or service line, may consider new revenue sources such as licensing or subscriptions to achieve the same objective. Furthermore, the reorganization may enable you to uncover new ways to give the same service for significantly less money. Transition to a new, complementary brand portfolio, or encounter clients in various ways that they prefer. Purchases and mergers. You are incorporating an existing firm into yours, whether by buying it outright or merging it with another company and absorbing its assets is one of the most effective ways to boost your firm's profitability immediately. Mergers and acquisitions can help your company grow swiftly in income, production capabilities, and market reach while avoiding the time and energy needed to start from scratch. Spin-offs and divestment. Suppose a division of your company is no longer economically viable or providing a vital position. In that case, you can sell it to obtain revenue or close it down to save money on running expenses. However, if you wish to reduce your involvement in a sector of your company without entirely abandoning it, a spin-off may be a better solution. It entails reorganizing the unit into a distinct company in which you will retain a stake. As a result, taking decisive and timely action, guided by an experienced advisor, can be a critical first step in successfully restructuring the organization. When to think about it, advice on business restructuring and recovery. A strategic assessment of performance makes good business sense at any time. Still, it's precious when a company hasn't reached or isn't expected to accomplish its objectives for whatever reason. For example, if you are in immediate or prospective danger of not paying your creditors when your debts are due, you should seek primary counsel before matters get worse. Recovery techniques. The two primary types of recovery strategies are as follows. Consolidation methods. The majority of retrenchment plans are expense strategies. One critical retrenchment method is to designate new ownership to accomplish the organizational transformation. Another option to generate cash is to dispose of systems that require storage, such as inventory. Typically, consolidation methods are designed to address a problem in the short term. Turnaround strategies. Turnaround plans are more concerned with making money. Instead, these tactics aim to increase a company's long-term viability. Developing new company models and generating new things are two examples. If your industry is rapid, you may need to adapt to remain competitive. Reorganizations are an excellent method to keep you firm, fresh, and ahead of the competition by incorporating them into strategy formulation. Make sure your approach is evidence-based, documented in a complete restructuring plan, and communicated effectively to all stakeholders at all times. You can ensure a smooth transition to your new operating model with solid guidance and diligent planning. If you like the video, give us a like to make more videos like this one, and tell us in the comment section below what type of videos you want. Lastly, don't forget to subscribe to the channel for more weekly videos.